What is the ICT trading strategy known as Cameron's model, and why is it considered such a powerful framework in trading? If you look at the structure on the screen, you can see that this model is not random or discretionary. It follows a clear three-step process. First, identify where liquidity is resting. Second, wait for that liquidity to be taken. And third, execute with precision using a structured entry model. This visual breakdown helps you understand that the edge does not come from prediction, but from alignment with liquidity and timing. At its foundation, this model is built around three core components: a draw on liquidity, a stop raid, and the entry. But what exactly is a draw on liquidity? It is the process of identifying a significant liquidity level that price is clearly moving toward. In practical terms, the market frequently gravitates toward areas where resting liquidity exists, such as equal highs, equal lows, or clearly defined swing highs and swing lows, because that is where clusters of pending orders are waiting to be executed and filled. So, in the first step of Cameron's model, you want to locate a key high or low on the 1-hour chart that price is approaching with intent. As shown in this example, we have a clear swing high on the hourly chart, and price is steadily drawing upward toward that level. We can reasonably anticipate price reaching this high because liquidity is resting there, and the market seeks efficiency. If you cannot identify a clear draw on liquidity on the 1-hour chart, you can refine your perspective by zooming into the 15-minute chart to gain additional structure and clarity. The next step is to identify a stop rate in the opposite direction of the draw on liquidity using the 5-minute chart for execution precision. So now, let us shift to a lower time frame. Keep in mind that in this example, the liquidity zone is positioned above current price. At this stage, we're looking for a swing low to be taken out, which is defined as a stop raid, meaning liquidity is being cleared before the anticipated move. Once that liquidity is removed, the final step is to look for fair value gap formations in order to set a buy limit with structure behind it. If you cannot find any fair value gaps on the 5-minute chart, you can zoom further into the 1-minute or even the 30-second chart to gain more precision and refine your entry. In a bearish scenario, the logic remains consistent and simply flips direction. First, identify a key liquidity zone that price is moving toward. Then switch to the 5-minute chart and wait patiently for a stop raid above a recent swing high. After that, locate a fair value gap and place a sell limit at the beginning of the FVG, positioning your stop loss just above it for protection. Always give price enough room to move naturally within structure, and avoid placing your stop loss too tight, as that can result in premature stop-outs and unnecessary losses. In summary, Cameron's model is powerful because it forces you to trade with structure, patience, and logic. Instead of guessing direction, you align with liquidity, wait for stops to be taken, and execute with confirmation. When applied consistently, this 3-step framework transforms trading from emotional decision-making into a disciplined and repeatable process. So trader, please remember that the ComLucro channel is focused on giving traders clarity, confidence, and structure. And this Smart Money Concept series is designed to do exactly that. Each video breaks down one ICT concept in a clear and practical way, helping you understand how price behaves, where liquidity forms, and how market structure develops. If this explanation helped you see the market with more clarity, make sure to check the full Smart Money Concepts playlist linked on the card and in the description, where all these ideas are organized step by step into a complete learning path.